Hello, everyone. Hope you're doing well. Welcome to the first Pro Traders Lounge lesson tutorial video. This is PC0813, joined by my colleague H. Paul, and we are here to discuss the topic with you of advanced trading fundamentals. Being perfectly honest with everyone here, we know this isn't the most thrilling topic. We get that. We don't like doing it. We know you guys don't love it. However, we have so many advanced trading techniques to give to you guys, so much insight to offer that it would not be responsible of us to not go over these fundamentals to begin with. We need to make sure that everyone who is going over our content has the basics all tied up and good to go. So that's what we're going to be going over here today.
Thanks for joining us, guys.
Specifically, what are we going to be talking about? We're going to be talking about the three basic types of traders and their mindsets. Why do we need to know their mindsets? So we can try to figure out what the rest of the market is thinking. That's a big part of how we trade. We're going to also be going over various types of trades. I have a feeling that a lot of you out there are misclassifying your trade types, and it's negatively impacting your P&L. We're going to go over that today. And lastly, we're going to go over recognizing the trading environment, because typically, if you're able to accurately recognize your trading environment, you can accurately apply the correct trade type and the corresponding trade treatment. How we take profits, set stop losses and validations, etc. So without any further ado, we're going to go ahead and jump right into the trader types and their mindsets. The beginner traders, fairly self-explanatory. We've all been there because we all had to start somewhere. Beginner traders are always excited or they're always scared. You know, they're either looking to chase a move or they're scared because the move is going too fast. Typically going with the trend. So if price is pumping up, they're looking for longs. They're never looking for reversals. However, they're usually extremely late in recognizing the trend. A lot of it has to do with minimal usage of technical analysis. A lot of it has to do with the fact that they don't really know the environment in which they're trading. Once you kind of learn some TA, get a little bit of experience under your belt, you start to feel a little bit more comfortable. And then we get into what I suspect the majority of the people that are watching this video would fall into this category: the intermediate traders. The intermediate traders are always looking to trade reversals. They rarely go with the trend. If they do look at trends, it's often just the local trend. And what do I mean by local? I mean like low time frame, the trend on the 15-minute or at most the 1-hour chart. They're often disregarding the information on the 4-hour, 12-hour, daily charts, the high time frame trends in context, and they're typically using way too many technical analysis tools and strategies. You may have heard the term paralysis from analysis. Intermediate traders often suffer from this phenomenon. They have way too much information that they're looking at. They don't know what to use. So they get confused or they get scared. And then once you've kind of had lots of experience, you've started to have some success, you start to graduate towards what we all hope that every single one of you will become, and that's an advanced trader. Advanced traders typically take less trades than beginner or intermediate traders because we know exactly what we're looking for and we're waiting for our levels. We kind of have what I like to call a sniper mentality. Instead of spraying shots with the machine gun, we are sitting there waiting for the perfect shot. And that shot is our entry. Advanced traders are typically very, very good at recognizing either the range-bound environment or the fact that price is in the middle of a trending impulse, and they will trade that environment accordingly. Most advanced traders, if they don't know what's going on, they just stay the heck out, because typically advanced traders use a very small, specific, and very thoroughly tested set of tools, something that they're comfortable with, that makes sense to them, and that has given them a degree of consistency and profitability.
Definitely. And understanding your trader type can be one of your strongest uh, advantages and help you move forward much quicker if you understand what type of trader you are, definitely.
Exactly. It's all about knowing yourself, knowing your strengths and knowing your weaknesses, being honest with yourself.
100%.
So now that we've talked about the types of traders, let's talk about our types of trades. Now, I'm going to go out on a limb and say that 80%, if you're watching this video, you probably take day trades. 80% of your trades are going to fall under these two categories: reactive scalps and scalps with potential. We're also going to go over day trades and swing trades because I hear those terms thrown around a lot. I don't necessarily see them applied correctly a lot. So let's go over these one by one. And these are kind of in order, going from your quick scalps up to your long trades in order. So starting with our reactive scalps. When do we even enter a reactive scalp? Typically, it's not from a planned level. It's something that you see a big, massive wick, quick price action, lots of liquidations, volume, low time frame volume indicators are telling you that we have an impulsive move, we have trap traders. You're trading from a reaction, hence the term reactive scalp. It's a very quick trade with quick take profits. We have to take profits extremely quickly. Personally, I recommend that our initial take profits are based upon, like I say here, numerical or percentage-based amounts. I like numerical. I like $100 from entry. If we go up into higher prices, I'll use $150 or $200 from entry. Some people like to sit down as the day starts and calculate what exactly is 0.5% for my entry today. And they will use that for their scalps on that specific day. Once you hit take profit 1 on a reactive scalp, your stop loss, again, this is just a recommendation, should be moved in front of your entry in profit. Because I've done statistics on this, if you're entering a trade from a non-pre-designated level, there is over a 90% chance that your entry is going to be taken out. So if we know that going into the trade, then let's go ahead and grab some extra profits when price is coming back towards our entry. You know, why pay those market fees? Let's just grab a couple extra bucks on the way out. And then we go into scalps with potential. It's similar, but treated slightly differently. The entry is based upon the reaction from a pre-designated support or resistance level. Now, going out on the limb here, most of your trades are going to be scalps with potential. What most people call day trades, I would class as a scalp with potential. People have too large of targets when they have an entry that they call a day trade. It's too ambitious of a target. They're not grabbing profits quickly while they're there to be taken. So with a scalp with potential, we're still grabbing a quick take profit 1, take profit 2. Perhaps after take profit 2, we're going to start doing our TP levels based upon technical analysis. We're finding SR levels, or we're just letting it run, seeing how much we can get out of that particular position. Once we hit TP1, just like reactive scalps, we move our stop loss up. Now, with a scalp with potential, if I catch a really good entry, I'll typically put that stop loss at entry or below the wick from which I'm trading. Same with reactive scalps. If you're entering right at the bottom of a wick, if you do get that nice entry, put your stop loss right below the wick. Keep it nice and close. That way we keep our risk nice and small. That's the whole point of this ball game, is to keep our risk small and our reward very large. So now Paul's going to walk us through a reactive scalp and a scalp with potential that he actually took himself.
So here we've got a reactive scalp, a scalp which came back and tested a daily open, which had confluence with a golden pocket. A trade that often happens for me, and I like at least two areas of confluence, basically. And this was perfectly on the golden pocket and the daily open. And you see here, I took a long from the daily open and the price moved up. We took $100 profit. We took profit at $100 up. and then essentially watch the trade run, move the stop loss, basically just beyond that $100. So we know we're in profit. As you can see here, the price moved up and then started to return back down to the entry, at which point we were stopped out in profit. Very simple reactive scalp, and profit taken. Happy days. The next scalp with potential that was taken, a very interesting scalp, this one. You'll see that we wicked above a support resistance level here and essentially created a swing failure pattern. So on noticing the swing failure, what we do is we try to enter the short as quickly as we can after the wick. At the top of the wick, we place our stop loss, and then we let the price action run down, obviously take some profit off the table, and whilst we've got our stop loss at the top of the wick, we let the trade run. It's important to remember to let your trades run. Because you see here, this looks like it's going to come back and take your entry out, but it didn't. And this is a very important thing in recognizing yourself as a trader to let the trades run. Because as you can see, when this ran, didn't touch the stop loss, came very close to it, but then we saw a massive drop thereafter. Really important patient trade there that paid off.
Exactly. Even if you're just letting a small percentage run, you would be shocked at how much a 10 or 5% position remainder can make you if you let it run, and it goes for a long run. It can turn into quite a winner if you let it run.
Something like that. Amazing. Yep.
So we've gone over the types of scalps. Now let's go ahead and talk about day trades and swing trades. So day trades, I know we hear the term a lot. How do we classify them? Entry is from a pre-designated support resistance level. I personally still like a quick take profit one. I always like to lock in the win. All of your other take profits really should be based upon support and resistance levels that you find via technical analysis, because these are longer term trades. We're not trying to go TP1, TP2, TP3 very, very, very fast. Maybe a quick TP1 to lock in the profits, make sure we make something. That way, if our trade does not work out, we're either breaking even or just a small loss. And then we move on from there. Like I said here, we can secure the win with stop loss at entry, or we could use an invalidation strategy. For day trades, in my opinion, it's a personal preference. My personal preference, I secure the win with stop loss at entry. Why? Because I can always re-enter that day trade. If it comes and hits my level again and I see the volume I like, I'm fine grabbing a little bit of profits on TP1. I get stopped out at entry. I'm fine re-entering that trade again if I'm confident in that level and the volume looks right. An invalidation strategy, one that I use for day trades, is a combination of the SR level from which I'm trading and time. For example, for a day trade, a common day trade invalidation strategy that I use is if we can get multiple 4-hour candle closes, or what I call a full close. A full close is where it opens and closes underneath the support and resistance level. If we get either of those, trades invalidated, we take our loss, no matter what the amount is. Even if it's right behind our entry, if it's still sitting there for an amount of time, then that level is being claimed opposite of the way we're trading, and we want to get out of that trade. Swing trades. And I made sure that this point was first and foremost to drive it into everyone's head. True swing trades are extremely rare. I'm talking a few a year is what most people get. In terms of an asset, you may get multiple swing trades on multiple assets, but on one specific asset, you're looking at 1 to 3 per year. So when I hear people saying that I'm a swing trader, I only look for swing trades, more often, they're looking for day trades, if I'm being perfectly honest. But what are the characteristics of a swing trade? Just like a day trade, we are entering from a pre-designated support and resistance level, typically comes from a higher time frame. All take profits are predetermined. The entire trade of a swing trade is predetermined. We don't need to take quick profits because this is supposed to be a long-term trade. If it takes 12 hours or a day and a half to get to our TP1, so be it. If it's a swing trade, That's what we're expecting. So we're not getting nervous and taking profits quickly. An invalidation strategy, very similar to a day trade, just adjusting the time frame. Again, me with a swing trade, I like to see if we have a full 12-hour or a daily candle close underneath the SR level from which we entered, the trade's invalidated. Now, why do I use these time frames? Because it takes the aspect of wicks out of the equation. If we enter from our swing trade level and price chops there for 4 straight days before making the move that we want, we don't get scared out of wicks. Wicks below our entry. Let's just say it even takes out the low if we're in a long. We don't get scared because our invalidation strategy incorporates time. So I need to see that level closed underneath within a certain amount of time. So it takes those liquidity grab wicks out of the equation. That's why I like using that invalidation strategy. And Paul's going to walk us through both a day and a swing trade that he recently took.
So here we have quite a simple day trade, some very straightforward support resistance lines here on the chart. And as you can see, the bottom line from where the trade was taken was a simple daily support resistance level. We've got an entry here just above the support resistance on the back test, basically going up to the first level of support resistance, which is quite clear here, and a perfect place to take profit. Up after that, we can see another support resistance level here, very clear, another great place to take profit. And then finally, we move up to a trend line, high time frame trend line. And you can see, again, just before this, a great place to take profit before a big drop, which can, of course, then be left running with a very small percentage on the table. And yeah, a great trade there for a day trade, basically.
And this also, in a great fashion, highlights our previous point. You can see here Paul's scalp with potential trade that we showed earlier. Look how much that ran. All the way down, just because we let our remainder run. There is power in letting winners run. Just wanted to emphasize that because this chart does a tremendous job of showing just how much those little amounts can build up to.
Absolutely. A great one here, a swing trade that I took quite recently, and very importantly, recognizing our environment, we were in a range here. You can see that basically what happened is we came back and tested the point of control. We were unable to break the point of control. We back tested it, which looked like a great place for me to take a long. The other markets around us were showing strength, and Bitcoin began to show strength just by backtesting this point of control. So a great place to take a long, in my opinion, at the time. And then another place to take profit early on was at a VWAP. We took some profit at the VWAP and let the rest run. We moved up to the top of the value area high, broke through that, then began to range above that. Obviously, again, a great place to take profit would have been just before the value area high. And then we continued to range and left some on the table to let it run or come back to our stop loss. Perfect.
And Paul mentioned the point of control, value area high. Perfect segue into our next topic of recognizing your environment. Paul's going to run you through the description of both ranges and impulses, and I will go through some examples with you.
Perfect. So recognizing the environment, the ranges and the impulses. Ranges, first of all. Price generally rotates back and forth between an upper and lower area of interest. Multiple touches on both areas of interest have occurred for a confirmed range. Predicting ranges is pretty useful. This will be covered in later tutorials. Remember, price tends to remain in a range-bound environment, generally 80% of the time for us traders. So that's very important to remember that. measure the volume of the range with the fixed range volume profile tool. You'll have seen this on some of the previous slides that we've shown. This determines the value area high and the value area low and shows the point of control. It generally tends to be, but not always, in the middle of those two value areas. Look for longs at the bottom of the value area low, look for shorts at the top of the value area high, and obviously remember that you should always take profit at the point of control. Quite often, again, like I say, in the middle of the range, generally in the middle of the range. These are great places for scalp entries or take profits, as I've said.
Mm-hmm. And like Paul just mentioned, I mean, we do have range highs, as you can see here, what we call a deviation. It's a deviation of the value area. This blue line right here is the value area high. Above that would be our range highs. So we could look to get what we call a sniper entry from the very tip top of our range highs, or we could look for acceptance back below our value area high. Either way, from this general area, we're looking for shorts. Conversely, down here at the lows, you can see we have a nice deviation here. We have a couple of deviation wicks off this daily support resistance level. We could try to snipe the lows of these wicks, or we could wait for acceptance back above the value area low to enter a confirmed range trade. Now with a range trade, like we mentioned, we're going to be taking profits at the point of control. You can see this is a beautiful example of range trading working out to perfection. Start over here. We short from the highs, we take profit at the point of control, we take profit at the lows. If we're entering a hedge, we might want to enter a scalp long. Once our value area low is claimed, again, we take profit at the point of control. We get stopped out. We re-enter. We take profit at the point of control. You can see the growing pattern over and over and over and over again. Once we deviate up to a value area high or low, and then start moving back towards the center of the range, there is a very good chance we're going to come down and hit that point of control. Hence why Paul mentioned earlier, it's a great take profit level. I know a lot of people love it for entries. I'm more preferable to using that as a scalp entry with the value area high and value area low, range high, range lows, offering the higher probability trades.
So in recognizing the environment, firstly, ranges are when we're trading a range, you can either look to snipe or catch the high or the low of the range, or even try to catch the deviation, or you can just wait if you want to be a bit safer to see the price come back within the range for a confirmed trade. The more times the range high and low is tested, the more probabilities that that corresponding range could be broken, basically. So, you know, the more it's tested, the more chance it could be broken. Ranges can occur simultaneously on high and low time frames, obviously. You know, one range can trade within another, and etc. So always remember your high time frame range context when you're attempting to trade in a low time frame range, if that makes sense.
And if it did not make sense, this picture should helpfully clear that up for you. This is a great example. You may see me quite often in Discord mention the words, "Don't forget where we are. Remember your high time frame context." I'm constantly repeating these words because I've found that most intermediate traders, which again, we're trying to graduate everyone from intermediate to advanced, they tend to fixate on the lower time frames, 1 hour and below. Now, if you're trading from that time frame, you've likely clearly recognized this range up here in the upper right-hand corner. It's a low time frame range. However, if you're just staring at that range and not remembering your high time frame context, that being we are well within this larger range, you may be trying to long the breakouts or short the breakdowns. You got to remember your high time frame context, especially shorting the breakdown of this range. We're above the value area high. If we hold the value area high, that is a bullish sign. We do not want to be shorting above the value area high unless we're looking to snipe a range deviation. We don't want to be shorting, again, right at the value area high. That is not what we want. We either want a sniper entry or a confirmed entry once we've accepted back within the value area. Anything in between that is very, very risky. Very, very risky. So yes, always remember where we are from the higher time frame context. Extremely, extremely important. And now that we've gone over ranges, Paul can go over impulses with us.
Yeah. So recognizing the range environment, basically, the impulses, the price is surging in one direction in an impulse. It often occurs upon the break of a range. Intermediate traders often get trapped trying to counter trade impulses, expecting a range reversal and not recognizing the break of the range with the impulse. Measure the volume of the impulse with a fixed range volume tool and look for mild retracements to enter trades that are alongside the trend. For example, impulses moving up, we look for longs. Trades taken mid-impulse should always be treated as either reactive scalps or a scalp with potential.
Absolutely. I cannot stress that last point enough. So often we see people entering trades mid-impulse and they are looking for the moon or they're looking for $0. If you are entering mid-impulse, you have to recognize that price can always turn around and you need to take profits quickly and secure that win. Like we talked about earlier, a lot of this is recognizing the type of trade that you're taking accurately. If you're entering mid-impulse and treating it like a day trade, why are you doing that? just ask yourself logically, why am I not taking profits quickly? You can see here we have a very clear impulse over the course of a couple days. This is the 15-minute time frame chart. There is no real break in 15-minute market structure. If you're staring at the 5-minute, you may see a 5-minute break. Again, that's why I don't like looking at those extremely low time frame charts. It doesn't help you keep in mind the higher time frame context. So typically 5 minutes about as low as I'm going. Rarely I'll look at the 5. In this particular instance, we have a very clear impulse up, goes on for about 2.5 days. Let's just say we don't want to enter mid-impulse, we want to wait for a confirmed entry. We get a clear fall, we break the 15-minute market structure. We use our fixed range tool to go from low to high to take a look at the volume of the impulse, and once we have dipped below and then reclaim the value area high of the impulse, that is a nice scalp long to take. So it's something that when we tell people to wait mid-impulse, wait because there will be data that presents itself to help you enter into trades.
So, recognizing the environment. Tools such as low time frame fair value gaps, 15-minute, 1-hour moving averages, local order flow, anchored VWAPs, and high time frame volume analysis helps recognize the trending impulse. We'll cover this later on in some later tutorials for you, though.
Right, because each pro trader, we all have our own different ways and tools that we can recognize a trending impulse. So that's got to be its own topic with its own tutorial. So we will be going over that in more detail.
Everyone can share their edge on that one, can't they?
Mm-hmm.
If you're not sure about the nature of the impulse, or why something's happening, where you should enter, I think the best thing to do in this instance is basically no trade is a trade, and preserving your capital is really important, and that's why you should just step back and wait for another range to form. Basically, ranges will form after a massive impulse or even a small impulse, and basically you can use your volume analysis tool to again find the range and start trading a potential range.
Right, looking back at the exact same impulse that we just examined, you can see the exact same impulse after it completed, a very clear range has formed. I mean, we have multiple taps on both sides. Like we discussed earlier, we could attempt to trade deviations of the range, catch the absolute highs, or we could wait for confirmation back within the value area, take it down to the point of control, etc., etc. One little tidbit, like we had mentioned earlier, you can use the volume from the impulse to help determine the upcoming range. This is a little sneak peek into a pro trader technique that we're going to be going over in later tutorials. But it's the same data that we looked at before, but you notice that the value area high of the impulse up helped us show the approximate range lows. This is like I mentioned earlier. Predicting ranges can be extremely useful. We're going to have an entire video tutorial going over using fixed range data, how I personally use it to help find these upcoming ranges. Trade them before they form. That way you will be in these trades, you will get primo entries before anyone has really seen that range has formed. It's not confirmed yet, but we're still trading it because we know the probabilities are good of it occurring. So just a sneak peek into that technique there. What do we have coming up next? Directly after this video, do not leave. We have a pro trader technique lesson tutorial video on TR pockets. These will help you catch those range deviations. If you're looking for those deviation sniper entries, you're going to want to watch the TR pocket video. Later today, we have our daily open close live session. We have our triple dip on Thursday, 3 live sessions, followed by our Friday morning daily live session, followed by charts and beers. Our next tutorial video following the TR pockets will be going over high time frame volume analysis, hosted by Dookie and Immy. That will be a great one you will not want to miss. And before we leave you all, please take a look at our disclaimer. Everything that we discussed today was not financial advice. It was for your educational and entertainment purposes only, and any trades that we discussed were paper trades. I hope you guys got some valuable information from this. As always, if you have any additional questions, please feel free to tag us in Discord. We're happy to help as best we can.
Brilliant. Thanks, PC.
And thank you, Paul, and thank you all for your time and attention. Have a great rest of the day, and we will catch you all soon.